Okay, let's dive in. If you've been watching the market reports from, say, mid-December, you might be feeling a bit of whiplash. The headline numbers look steady, but underneath, things feel intense. So today, we're cutting through that noise to really understand the structural conflict driving asset prices, based on the December 18th report.
And that's the fascinating part, isn't it? The market isn't just reacting to one thing. It's being pulled in two totally distinct directions at the same time.
A dual-axis environment. That's the phrase that really stood out.
Exactly. You've got these, mechanical liquidity forces on one side, and then these super high-frequency, event-driven swings on the other.
So let's start with the biggest machine in the room, macro picture and the Fed.
Right. If you look at the cost of money, the U.S. 10-year Treasury is sitting around 4.14%.
Okay.
But the 2-year is near 3.50%. That gives you a relatively flat curve, which is basically the market shrugging its shoulders. It's a sign of tension, of uncertainty about long-term growth.
And that uncertainty makes everyone jumpy. Which is where this new thing from the Fed comes in, right? The Reserve Management Purchases, or RMP.
That is the core variable right now. The Fed has started these RMPs to replenish bank reserves and manage the short end of the market.
So let's clarify for everyone listening, how is this different from QE? Quantitative easing.
Yeah.
Because the Fed buying assets, that sounds a lot like QE.
It's a great question, and it's a crucial operational difference. QE was a massive policy shift. Think of RMP as like specialized maintenance work on the financial plumbing.
Just grease in the gears.
Exactly. It's a technical necessity to keep short-term funding markets from seizing up without changing their broader fight against inflation. It gives them a stable floor for liquidity.
Okay, so we have a stable floor. But now let's talk about where the instability is breaking through, because it's definitely not calm everywhere. What's the VIX telling us?
Well, the VIX, the fear index, is around 16. That's pretty low, which suggests no one is bracing in a huge crash. But the report notes that it reacts very fast to sudden news. The fuse is short.
And you can see that perfectly in the ETFs. VOO, the S&P 500, is trading pretty sideways, kind of calm.
Yeah, it's buoyed by that RMP liquidity we were talking about.
But then you look at QQQM, the NASDAQ Q100, and it is way more volatile. That's where the event-driven axis just takes over.
And that tells you money is flowing cautiously. We're seeing funds pull back from high beta tech into money markets. Investors are choosing safety over momentum right now.
So what's the trigger? The sources point directly to one company, NVDA.
This is arguably the single most important story in the equity market. The U.S. approved the export of the H200 chip to China, but, and this is the key, the approval came with a lot of conditions and fees.
And the market hates uncertainty.
Right. It's not about the yes, it's about the yes, bud. The question now is, do these conditions kill the deal? Does this approval actually turn into real high-volume orders? Any tremor at NVDA immediately shakes confidence across the whole AI sector. It's the barometer for everything. So we've got stable liquidity on one side and this high-stakes regulatory news on the other. Now, let's move to where caution has turned into outright panic, crypto.
The sentiment drop there is just profound. The crypto fear and greed index is in the extreme fear zone. We're talking readings as low as 11. This isn't just caution, it's a collapse in confidence.
And what's that doing to prices?
It's creating constant pressure. BTC pulled back from near 90K and is now struggling around 86K. ETH is also hurting, down around $2,800.
And the report points to a mechanical reason for this beyond just sentiment.
Yes. High market leverage. The system is it's over-leveraged. So when prices dip even a little, you get these cascading automatic liquidations that just accelerate the downturn.
Which means we need to issue a pretty strong warning about some of the instruments mentioned, like HYPE tokens or those pre-stocks.
Absolutely. Pre-stocks, trading shares of private companies like OpenAI on a blockchain. These carry enormous concentration risk. You have to verify the contracts, the custody. If you can't, the risk is just off the charts. So, to put it all together, the Fed is providing some stability, a technical floor.
Right, the RMP is the stabilizer.
But under that surface, the market is moving frantically based on very specific events, like the NVDA news or this crypto leverage unwind.
That tension is dictating everything right now.
So what's the takeaway? What does this environment demand from you if you're trying to navigate it?
Risk control first and foremost. The report is clear. Build your positions gradually, don't rush in, and you need defensive hedges. Things like short-term debt, money market funds, and a gold ETF position.
And on the flip side, what should we be strictly avoiding?
Aggressive exposure. The market is ruthlessly punishing leverage, so that means no leverage in BTC or ETH, and staying far away from big, unverified bets on things like those pre-stocks. Verification and slow accumulation are what's being rewarded.
That's incredibly clear. Okay, before we wrap this deep dive, let's leave our listeners with a final thought to chew on.
So we spent a lot of time on the New York Fed's RMP, this technical injection of liquidity. At the same time, the Fed's stated goal is still eventual policy normalization, right? Gradually getting rates down.
Okay, yeah.
The question you should be asking yourself is, how will the market ultimately reconcile this operational expansion of the balance sheet through RMP with the stated long-term goal of policy normalization? That tension between the plumbing and the policy is probably the dynamic that's going to define the next quarter.